In terms of the euro, what you need to know. Well, there's a lot of unique characteristics about trading the euro that make it so interesting for traders around the world, and why most of us, when we come to these sessions, our main question is centered around the euro. The reason for that is because the euro is the most liquid currency in the world. It is the most actively traded currency. Bank of International Settlements releases its volume reports on a regular basis, and if you take a look at this, you'll see that the majority of currency traders start with the euro dollar, and they're interested in the euro dollar. Now, the reason for that is because its liquidity creates an environment where the spreads are usually tighter, and when the spreads are usually tighter, the transaction costs are a little lower, and with all these different currency pairs that brokers offer from 20 to 200. A good place to start tends to be the most liquid and most covered currency in the world, the currency pair in the world, and that's the euro dollar. Now, the most important thing that you should remember about the euro dollar is that it is a currency for 17 different countries. That's a good thing, that's a bad thing. Unfortunately, these days, it is the source of the euro's troubles. And it is one of the main reasons why, throughout the past decade, the British were adamantly opposed to joining the euro. Because maybe in their crystal ball, they saw that these would be the consequences of being part of the eurozone, which if the UK adopted the euro, they would be in just as bad of a situation and be forced rather than just asked to put up some money to save the eurozone and the weaker members of the region. Now, in terms of trading the euro, as we saw today, the euro moves both U.S. and eurozone development. So what I was going to say is that, as you saw today, how the euro moves is dependent upon both U.S. and eurozone development. For a very long time, the euro dollar was considered the anti-dollar. And this was the case, I would say, even about a couple of weeks ago, where the euro dollar traded, once we had Greece default, and we had the CDS spreads launched, and we had the CDS default, and then we also had payments triggered, we saw the impact or the driver market movement shift from the Greek saga over to U.S. monetary policy and U.S. development. That's when the dollar was rising in both good and bad news, because there was a very consistent improvement in U.S. Fundamentals, meaning the U.S. economy. We saw very consistent improvement in the U.S. labor market. We also saw a very consistent improvement, in terms of, many other aspects of the economy. So the dollar started to rise, and that drove, euro dollar lower. But when we had a little bit of risk aversion, we also saw the dollar, benefit from that. But today, what we're seeing is that all of the optimism that was centered in the dollar, which had driven, bond yields higher, which has driven the greenback higher, is evaporating. And the reason for that is because, we had the Federal Reserve acknowledge all the improvements in the U.S. economy, according to the last FOMC statement, and it sounded like they really didn't want to or felt the need to add another round of quantitative easing. But today, this morning, Bernanke was pretty crystal clear. If you read my report this morning or the note that I put out, or you follow my Twitter, you'll see that I said that the number of times that Bernanke used the word accommodative, it was a very strong sign to us that QE3 is still on the table. In terms of the level of unemployment, it's declined, but it's not declining at a fast enough pace for the Federal Reserve to eliminate the need for more stimulus. Bernanke really felt that in order to change the economy from recovery to growth, they really felt the need to add or keep monetary policy easy. That was the only way that they could bring the economy from just a recovery mode over to a growth mode. And they also weren't sure if the improvements in the unemployment rate was going to last. So all of that basically left QE on the table, as Nancy said, and that drove the U.S. dollar sharply lower because everyone had to readjust their interest rate expectations. They went from no QE to more QE, and typically when we have this type of scenario, it usually leads to a reaction in the euro dollar that lasts, or the dollar specifically that lasts. It's not just a one-day reaction. Typically, it's a series of reactions, because I think that this message will be one that will be reinforced by Federal Reserve officials in the days to come. And the more consistency we hear from Federal Reserve officials, where they do say, yes, we're worried, that could really hurt the dollar and really cause U.S. yields to compress and reverse some of the gains that we had in the greenback, particularly against the Japanese yen. So that's, the dollar in general. What we're focused on today is the euro. In terms of Europe, there's a couple of things that, we have to pay attention to, and I'll show you how the Eurozone economy is doing in just a second. But we've got something that's rather unique about the euro dollar, which, as I said, it trades on both U.S. as well as Eurozone development. So there's two very unique characteristics of the dollar. It's either considered a risk-on trade or risk-off trade for the most part. So when it comes to euro dollar, we have weak U.S. data. It actually can be more hurtful for the euro dollar than helpful, because sometimes in those cases, a lot of people worried about how it impacts the Eurozone economy as well as the U.S. economy. So one of the tips I always give for currency traders is that when it comes to trading non-farm payrolls, the euro dollar is like the worst currency to trade NFPs. We all know that NFPs can be extremely, extremely volatile, but it's much better to trade NFPs through something that's a little bit has a little bit more of a direct correlation with how the U.S. economy is doing and just the U.S. in general, and that would be dollar yen. So when it comes to U.S. economic data, what I prefer to do is I prefer to trade dollar yen versus the euro dollar. But because the euro dollar, oftentimes, like let's say we have a really strong non-farm payrolls report, what you may initially see is the euro dollar will initially decline because a strong NFP report will drive the U.S. dollar higher against the euro. But then what will happen shortly thereafter, particularly when the U.S. stock market starts to open, is that then risk appetite starts to turn positive. You see stocks rally and, investors get a little excited, and that's when they start to buy euros, and you get a nice little, what we call the V-shaped reversal. So when it comes to trading the euro dollar, I think risk appetite is much more important than economic data when it comes to U.S. economic data. But Eurozone economic data is important. And that's why, this shows you how the Eurozone economy has been performing as of late. One of the big stories last week was the major disappointment that we had in Eurozone PMI numbers. This little chart here, or this little image here, shows you that from a growth perspective, we have seen deterioration in both service and manufacturing activity. If you actually take a look at the PMI numbers, both service and manufacturing activity is contracting in the Eurozone. And there's a great fear that because both of these numbers are below 50, that could basically point to the fact that we may have another quarter of negative GDP growth in the Eurozone, which would put Europe in a quote-unquote technical recession. So that is obviously very bad for the euro. And also we saw German producer prices released earlier this month, and even though we had oil prices on the rise, we don't have too much of an uptick in producer price growth.